We're getting some deceleration, and this equity market is absolutely exploding. Joining us now to discuss, Jim Bianco of Bianco Research, Krishna Mamani of Lafayette College. Jim Bianco, the floor is yours, sir. What do you make of this one?
Well, in one respect, it shouldn't come as a surprise that inflation has peaked. I think everybody understood that. And I think the bigger discussion that we need to have is how far down is it going to go? Is it going to bottom out at 2% or something above that? I'm in the persistent camp. It's going to bottom out something before that. But as far as today's action goes, Jonathan, we're only a couple of weeks away from the one-year anniversary of when Chairman Powell said we need to retire the word transitory. We've never retired the word transitory. Most of Wall Street still believes that this inflation is transitory, or the Fed's got to pause, or they got to pivot, or they got to step down, or whatever variation we want to use on that. And this is only the third time in the last 20 months that the inflation number has come in below expectations. And this is what everybody's been hoping for. So you can see the jubilation and the incredible move in the markets right now. But after we look at today, we're going to have to ask the question, do we go all the way back to 2%, or do we go back to 3.5% or 4%? Because we go back to 3.5% or 4% and stop there, then the Fed's not done.
Let's go through this with purpose. Jim Bianco, we've got a 20 basis point move at the front end of the curve at 437. In the equity market, the S&P 500's up by more than 3%. The NASDAQ is like +4 right now. Jim, have you ever seen a move like this off the back of a single data point in America?
I don't think I can recall ever seeing from one trade to the next a 2.5% up move in the stock market on the futures contract like that. I've never really seen it. And it just goes to how focused and how important this data is. This is the most important event of the month right now for all financial markets, is the release of the CPI report.
Krishna, I know you're itching to jump in. It's all yours.
Well, so I take the other side of what Jim was just saying. I don't think, based on what Jay Powell was saying in his presser, one could conclude that in the judgment of the FOMC, which is what matters more than anything else, that inflation had peaked. That's why we had price terminal rate meaningfully higher out of the press conference. So I think there are people who were hoping for this, but I don't think that's what the FOMC was hoping for. And therefore, it is a total surprise, and it is definitely a welcome surprise from their perspective.
Jim?
The real question is, will this persist? I think this month a whole bunch of things came together. And to Jim's point, it is quite probable that we probably don't see this trend continue, and we may actually see a bit of a reversal.
Well, Krishna, you're both asking the same question, aren't you? And the same question is, basically, where do we bottom out? A few months down the road, a few quarters down the road, Krishna, where are you thinking we bottom out? Do we get stuck at 3, 4? Is that the conversation, the thought, the debate that you're having?
Yeah, so I think the bottoming off will probably be more like the first quarter of next year rather than the fourth quarter of this year. Again, as I said, a whole bunch of things came together. This is a good number. It indicates where we are headed. However, looking at it and running with it in full form, I don't think is really the right thing to do.
Jim Bianco, your reaction?
Yeah, no, I think that it really is a question about, where we are going to bottom, and that is going to really drive the Fed. And that's going to drive really the debate now. The debate is I know everybody focuses debate on December and whether or not we're going to move 50 or 75 in December. It now looks like 50, and the market's overwhelmingly pricing that in. But where is the terminal rate going to be? I still think if we have a sticky, persistent inflation problem, the terminal rate is still going to be around 5%. Maybe it's not going to be 5.25. It might be 4.75 to 5 as opposed to 5 to 5.25. But it's not going to go down to 4 or 3. And we're not going to, get the Fed to have some kind of a major change unless we see a lot of collaboration in this data. And that means weaker payrolls, weaker earnings, weaker GDP to fit with a narrative that the economy has seriously decelerated. We don't have that. Lost in today's debate right now is, that the initial claims number was actually okay at 225,000. So that's still historically a very low number. And so we're not seeing any evidence from that that there's a problem in the labor market.
Jim, I want to pick up on something you just said and compare it to something you said a little bit earlier. We're doing more than just pricing in 75 to 50, aren't we, with a move of 3% in the equity market and a move of 20 basis points lower right the way through the curve. That's more than just pricing out 75, isn't it? We're pricing something else in for next year, it feels like.
Yeah, I agree. I think, go back to my original comment. The vast majority of people still think inflation is transitory. They still think the Fed is overdoing it. They still don't understand why Jay Powell is being so hawkish and becoming Volcker 2.0. And they're looking at this data and saying, this is it. The Fed's going to stop. And maybe next year they're going to start cutting rates. We're going to turn the printing presses back on. And we're going to go back to 2019. And it's all going to be okay. That's really what the hope is in this market. And today's number fed right into that.
Big move in the equity market on the S&P up 3%. Yields lower on a 2-year by 21 basis points. Yields lower right the way through the curve. On a 10-year, we're down about 17 or 18 basis points. So yields down, equities up. Guess what the dollar's doing? It's a whole lot weaker. Euro dollar reclaims 101.18. That currency pair with a 1% move higher. Mike McKee, you've had about 36 minutes to go through this one. What do you make of it?
Well, in general, it's good news. You look at the headline numbers and we see that they came in better than expected in every category. The numbers that really matter to the Fed are the monthly changes. And there we saw the headline numbers drop to 0.4 for the headline, and the core drops to a 0.3 move. And it does start to show maybe the beginning of a sequential decline. Now, what moved is also important. Gasoline was up by 0.4 after dropping by 0.5% last month, by dropping 5% last month, and that was to be expected. But food at home drops, owner's equivalent rent is lower, used cars are lower, apparel is lower. Goods prices in general are falling, and that's what really drove the number down. Now, the bad news side is that services prices are still rising at an increasing pace. So that's what's going to have to turn around for the Fed to get where it wants to go. We do have a lot of Fed speak today. We'll get some interesting reactions to that. We can see here the pricing for the December Fed meeting. It's dropped to basically almost a 1/4 point, not just a 1/2 point, but below a 1/2 point. We'll see where it goes from there. The terminal rate that Jim Bianco was talking about is at 4.88 in May. So that hasn't dropped a lot from 5%. That would imply a 5% rate. The first Fed official to speak after the number came out is Patrick Harker from Philadelphia. Now, he's saying that he thinks PCE inflation, which runs lower than CPI, is going to be at 3.5 by the end of next year, which would be appreciable progress. And he says this: in light of the cumulative tightening we have achieved, I suspect we will slow the pace of our rate hikes as we approach a sufficiently restrictive stance. But I want to be clear, a rate hike of 50 basis points will still be significant. And he goes on to say, we also need to recognize this will take time. Inflation is known to shoot up like a rocket and then come down like a feather.
Mike McKee, thank you, sir. That's quite a quote. That's Harker behind us. Then you've got Logan, Daly, Mester, George all lined up to respond to this and I guess respond to what's happening with Fed policy into next year as well. Krishna, we need to talk about consequences. We've had 400 basis points of tightening basically in 8 months. That's a lot of tightening in a very short amount of time. Now we need to talk about consequences. Is the price we're going to pay for that a 25% move on the S&P 500? Was that it? Or are you looking for more?
Well, so again, as I said, whether this trend persists or not is really going to be the driver for this. But I think that going back to a point that Jim was making, the difference, or at least the impact, is really not whether we moved much on the terminal rate today. I think the impact really is we are pricing out the likelihood of terminal rate at 6, 7, 8%. We are basically capping the terminal rate. If that's the case, I think there's a good case to be made that we have probably seen the bottom of the equity market. Again, for that to be the case, the trend in inflation has to persist. That remains to be seen.
Jim, your thoughts?
Yeah, I mean, the terminal rate probably is getting capped out at around 5% right now. And there's been talk earlier this week that it might be going somewhere higher, like to 6 or 7, as Chris just said. But I do think that we need to, and I'm going to agree with you, we need to see some kind of a massive deceleration in the market, in inflation, in order to say that the equity market is bottom. Now, we've got one good number, as I mentioned before. It's only the third time in 20 months that we've gotten a good number. Let's see if it gets followed through in the data over the next 2 or 3 months, whether or not that it supports this idea that the Fed can just raise rates 50 basis points a couple of more times, and then they can pause for the rest of 2023.
Well, here's the runway for the rest of 2022. December 2nd payrolls, December 13th CPI, the Federal Reserve meeting December 14th. For those of you interested in the politics, I believe the Georgia runoffs are slated in for December 6th. Jim Bianco, there'll be a lot of people writing stories today about so-called soft landings. What would you say back to them?
It's too early to say whether or not we've had a soft landing. What we've had is we've had one good number on inflation, and we have yet to see a turn in the data, especially in the labor data, and I'm thinking about the payrolls report, to suggest that we've actually started a soft landing just yet. So it's still very much an open question as to whether or not we're actually going to get one.
Krishna, final word on that.
Well, I think the likelihood of soft landing has gone up meaningfully. If you get this sort of inflation data, while the growth outlook is actually remaining relatively strong, that's what you need for a soft landing to come about. So the probability is meaningfully higher. I disagree with Jim on that count.
Krishna Mamani, Jim Bianco, sticking with us. Equities right now up by more than 3 percentage points. Coming up on this program, more good news for President Biden.
While the press and the pundits are predicting a giant red wave, it didn't happen.
That conversation up next.
While the press and the pundits are predicting a giant red wave, it didn't happen. And I know you were somewhat miffed by my obsessive optimism, but I felt good during the whole process.
And that was a little bit of a victory lap for the president yesterday. Good news for the Biden administration. The latest inflation data showing slower pace of price increases, and Democrats delivering better than expected midterm results, with the Senate still up for grabs. Joining us down in D.C. is Bloomberg's Anne-Marie. Morning, Anne-Marie.
Good morning, John. Really a sigh of relief, I imagine, for the White House. Of course, inflation north of 7% is still way too high for any politician, but it's the highest, lowest it's been since January. So the Biden administration, we're waiting for what they have to say on this inflation report, but clearly this is a sign that things are moving in the right direction. And yesterday, when the president came out to talk about the midterm election results and really just, really wanted to rub it into the press in the room, saying that maybe we were miffed and didn't believe his optimism. The fact of the matter is he brought up inflation. He said he can't guarantee that they're going to be able to get rid of it, but he did say things were moving in the right direction, and he pointed to the likes of gasoline going down.
He's going to the G20 in a very, very different mood. AMH, you're going to cover that for us, and I think we're going to catch up with you a little bit later this hour as well. Looking forward to it. AMH down in D.C. Julian Emanuel of Evercore wrote a fantastic note yesterday evening. I picked out a quote, but we're going to talk about something else he talked about. Here's the quote for him. The uncorrelated outcomes of elections across the U.S. reinforce the idea that much like stocks in 22, voters prefer governance and local issue alpha over political party big picture beta. He went on to say election integrity rhetoric likely moderates a win for everyone. That was Julian Emanuel of Evercore. He also talked about crypto and contagion, and I want to have that conversation right now with Jim Bianco and Krishna Mamani. Jim, walk us through what you're seeing in an asset class that you've followed more than most, and the prospect for contagion from your perspective.
I think the prospect is very high for contagion. FTX is an offshore exchange. It's the second largest in the world. There are hundreds of thousands of accounts on that exchange. That includes institutional accounts. That includes the treasuries of crypto protocols. That includes hedge funds. That includes other brokers. That includes institutional investors, miners, validators. Their money is trapped on that exchange. They need to be able to access their money because they've got obligations they have to meet. They've got counterparties they have to satisfy. If that exchange does not reopen and allow them to have withdrawals, then they're going to fail to their counterparties. Their counterparties are going to fail to their counterparties. Crypto protocols, especially those that were tied up with FTX Ventures, that raised money, have their money in FTX accounts. They can't access it anymore. They can't pay payroll. They can't do anything with it. So if this exchange cannot reopen, it's the impact, the knock-on effects are going to reverberate all throughout the entire crypto space, and it might even start to leak into the traditional financial space, especially the tech space. We've already seen that Sequoia has written their $100+ million investment down to zero. There'll be other things along those lines as we move forward if this exchange cannot reopen.
Jim, can you help us understand the numbers here and the depth of institutional adoption that you think is of concern when it comes to contagion through traditional asset classes like the ones you just talked about?
You know, in total, it is estimated that there's about $40 billion of institutional money that has come into crypto protocols in the last 10 years. 25 of that came in last year. That's money that's investing directly in these protocols, not buying coins. That's a different story. A lot of that money has been lost. A lot of that money was in the Terra Luna blockchain. It was in FTX. It was in Celsius. It was in Voyager. It was in BlockFi. These are all exchanges and protocols that have failed this year. So a lot of that money has not just had a bad year, it's gone to zero is what's happened. And so this is going to probably cause a review and a rethink as to how one should be investing in this space as we go forward.
Krishna, how are you thinking about this situation?
Well, so I think Jim makes a good point. That is, FTX failure certainly will have a contagion effect. I wonder if the magnitude would be of the level that he's talking about. That is, the institutional investors, especially VC investing in this space, really has been very, very aggressive. So certainly there is going to be a meaningful markdown of those types of valuations. But I don't think this is really saying, or this, it would be appropriate to say that all of that is basically going down to zero. I think there are lots of protocols, lots of work that will probably persist even after we go into a relatively cold winter for crypto per se. I think this definitely puts takes the oxygen out of the atmosphere, but it doesn't really get it down to zero, or we are not in a vacuum any longer.
Well, Jim, how cold do you think that winter's going to be? And I guess the question I'm asking is how deep do you think the scars will be for this asset class, given what it's gone through over the last 12 months?
Oh, I think that the scars are going to be deep because what they've been relying on, in the phrase we like to use there, is building. We need to build new protocols. We need to build new opportunities. And in order to do that, you need money from VCs. You need money from outside investors to come into the protocols. That's what would drive the idea that cryptocurrency coins would go up. Well, that's what's really been hurt a lot, as we've seen this year. And so if you're looking to raise money because you've got a better idea on a crypto protocol, it got a whole lot harder in the last 3 or 4 days than it has been. And a lot of people that might even give you money have gotten so many losses that they might not even have the capacity to give you money anymore. So no, will crypto get through this? Yes, crypto will get through this. But this is going to be a very tough slog. And crypto's seen this before in 2016 and 2019. It can get very, very dark before the skies break and things get better.
Well, it's certainly dark now and it's getting darker. Jim, great to catch up with you, sir. Jim Bianco, Krishna Mamani, to the both of you. What a move we're seeing in this market, away from Bitcoin at the moment, which is trading at about 17K right now, down from pushing 60, 70 12 months ago. The S&P 500 is absolutely ripping, up by more than 3%. In the bond market, yields lower by about 19 basis points. And the dollar in this FX market is a whole lot weaker. With some breaking news just moments ago, here's Abby.
Indeed, John, and related to everything that you all were talking about in the terms of the possibility of crypto contagion and that liquidity crunch, the dark web, we just had breaking headlines around the FTX CEO tweeting that Alameda Research is winding down trading. They aren't doing any of the weird things that I see on Twitter, and nothing large at all. And one way or another, soon they won't be trading on FTX anymore. This, of course, is FTX CEO Sam Bankman-Fried, also owner of Alameda, an embattled crypto proprietary trading trading and venture capital firm. It's gone dark. There have been several reports this morning about the fact that it's going dark and that they're no longer trading crypto. But here we do have confirmation of that from the FTX CEO, Sam Bankman-Fried. So this story continues to go on. It'd be interesting, John, of course, to see how far and wide it continues to go.
Abby, thank you. Got some coverage coming up a little bit later for you. Shanali Basak, a Wall Street correspondent, is going to break things down for you piece by piece. Peter Chi of Academy is going to weigh on this potential for contagion as well, from crypto through traditional asset classes. Right now, we're absolutely ripping. If you're just tuning in, big downside surprise on inflation in America, and this market explodes higher. On the S&P 500, up by 3.6%. Coming up, the morning calls, and later on a rip-roaring rally, we'll catch up with Victoria Fernandez at Crossmark in about 7 minutes' time. This is Bloomberg.